Hello and welcome to Switzer Investing TV. I'm Peter Switzer. Thanks for joining me. On tonight's program, I've asked the fund manager, Jun Bei Liu of Tribeca Alpha Plus, to look at the stocks that are the most shorted stocks on the Australian stock market to see if they're worth buying or not. And then Paul Rickard looks at what it takes to create a very good income portfolio. He's been doing it for over 11 years for the Switzer report, and his returns have been in excess of 9% per annum. We'll see what's behind it and whether we can expect dividends to remain high as they have been in recent years. So let's kick off now with Jun Bei Liu of Tribeca Alpha Plus. Thanks for joining us, Jun Bei Liu.
Thank you for having me, Peter.
All right, now, before I ask you about some shorted stocks and whether you like the companies or not, I thought I'd just ask this simple question. What do you think is going to happen to interest rates this year?
I think interest rate won't move this year, either here or globally or in the US. I think the economy is pretty strong, even though it's slowing, but they're just slowing slowly. In a way, it's good. The corporate earnings good, consumer sort of holding up okay, but it doesn't hit all the mark for the rate cuts. Wow. So I think it's more likely to be next year in terms of the first rate cut.
Okay. Let's look at some stocks that are shorted. And when I looked at them, some of them I know you do like. Let's start with the most shortest stock on the market, and that's Pilbara Minerals.
It's crazy. So you look through some of those stocks, you just think, what were they thinking? Look, I think the reason Pilbara Minerals is heavily shorted, I think it's a buy. It's been shorted because the lithium prices have yet to return. It's come up a little bit, but still pretty tough. And for the next 12 months, actually, lithium prices does look like it's going to move higher. But why do they short it? It's really, most of them actually come from offshore hedge funds, and they have no other way of shorting lithium exposure. Pilbara is the biggest and most liquid, and most pure. So they just decide that's the only way to go. They wouldn't be shorting the smaller one. Smaller one is harder to do, just in case they get stopped out. When there are too many short sellers, and when someone recalls the stock, you have to buy it back.
Okay, so but also because there's so many shorts on this, when they have a turnaround and when the outlook for Pilbara is looking much better, the short squeeze will be such that there should be a big rebound in the stock price. Is that the history of that sort of thing?
Definitely. Remember GameStop?
Yeah.
So the rebound, not only the stock meant to go higher because earning goes higher, it's actually short sellers are forced to buy back.
They rush to be...
They rush because they have to. Yeah. Because when you think about a short seller, you can make unlimited loss. If it keeps going higher, you keep earning more and more money, so you have to pay it back, and everybody will be doing the same if you got so much short. And then when there's such big parts of your cash share register, they're just not enough sellers to sell.
And because they've been short sellers, they have to be buyers, and the more they rush to buy, the more they will aggressively
push up.
So the first one to the exit wins. The last one really cops it.
Yeah, that's right. Actually, someone told me once when I first started my career is the short seller is the only person that have to buy the share at some point.
Good point. Let's go to IDP Education. This is the second most shorted company. Now, I know in the past you've thought it's a good company.
Look, I do think it's a very good company. The reason they've been shorted is simply because they worry that, around the world, there's a bit of immigration curb at the moment because of I think something like 30 countries are going to election this year around the world. So,
and then the immigration, lower immigration.
Exactly. But what we have seen from a couple of countries already, even though they're talking about it, but the actual number cut is not very big. And the company itself, if you remember from 6 months ago when they reported, they're doing so much better than the industry. So right now it's a blanket short. So come results, if they do any bit better than the expectation, share price can move very, very aggressively.
Okay, so there's two heavily short stocks you both like. Let's go to number 3. Number 3 is Syrah Resources.
Okay, so this is another one sitting in that new metal space. Yeah, so this one's graphite.
Graphite.
And it's the same thing. So what those Asian hedge fund short sellers are doing is that they're shorting a lot of those mineral that hasn't been doing very well, and they think there's chance of oversupply, and then they put in more money into the one that has done very well, such as metal, the copper. So copper, they have all their money, so they short this side and then use that money to buy the likes of copper. And at some point, we've seen copper has done so well, that trade is going to reverse.
Yeah, and so this is another company you think it's a good company, but it might take some time for the share price to move, but you're fairly confident eventually it will move in the right direction.
No, yeah, absolutely.
Yeah, okay. Flight Centre.
Oh, it really surprised me why the short base is so high.
Yeah.
I think there's a level of the worry about Australian economy potentially slowing down and the like. But if you compare Flight Centre's performance against Webjet, I know Webjet is more global and the like, but even Flight Centre got a great US business now, corporate travel, it's doing well, and it's so much cheaper. And Flight Centre is talking to increase margin, which no one believes. So, I think it's unfounded to have this high level of short, and I think the stock is cheap enough. As we head into the next result in a couple of months' time, you should see a fair bit of upside.
What do you think of Chalice Mining? Does it fit into the same boat? I know that Tim Goyder when it fell a year or so ago, he put about 5 million into it straight away, and he was the chairman. So, but when it kept falling. Is it sort of another mining stock that's just at the moment is being shorted, and one day you suspect it'll turn around?
Look, I think so. This one I'm not too close with, but I do think a lot of those mining stock, the minute there's a bit of operational near-term issues, the investors tend to steer away, particularly in the current environment where everything's a little bit uncertain.
Yep.
So the risk appetite is low.
What about Helios?
So Helios, we are talking about problem. So Helios is a very defensive company in pathology space and a bit of radiology assets. They sold all their, their doctors, the GP business now. So
got rid of their doctors.
They got rid of the doctors, but unfortunately, when you got rid of the doctors, it's the pathology business been pretty tough. The cost is going through the roof, and yet government doesn't give you enough pricing power. So you put up prices for the pathology testing. So things been really, really tough. And the debt is very high. They're selling the radiology business, but we don't know how and when and what price. So it's a little bit uncertain at the moment, but for the such high short base, I think it's probably looking okay at the moment.
But there's not one that you'd be rushing to buy?
Not yet, debt too high.
Okay. Let's go to a company like Linus. Now, I know I'm doing a lot of miners, and you aren't necessarily a miner buyer, but you do buy mining.
I do. Yeah, I actually see why Linus is a short. Look, rare earth price has been very, very difficult, and it's highly political. So China can just come up with a price, and it's very hard to. It's not driven by supply and demand, so it's actually very, very difficult to work out what it is. And anyone that can forecast rare earth price is, it's probably, I don't know, something special to be able to guess that. So I think it's very hard. So what people are doing now, I can see what that trade is. They probably long buy the Iluka, which has the rare earth sort of component to it. You know how they're building the asset. And then, but Iluka, the other side of the Iluka, which is mineral sands, is actually seeing price increases. But Iluka share price hasn't really done all that much. So in a way, by buying Iluka, you have exposure both to the rare earth and the mineral sand, which is moving. And then the price is going higher as well. So it's a global peers for in the mineral sand. Price has gone up so much, whereas Iluka hasn't because of rare earth. So I think a lot of people sitting there probably thinking, look, Linus has gone up quite a bit, or sell that one and put into Iluka, which is a little bit lagged behind.
Okay, this is an easy one. Bank of Queensland.
Yeah, look, I think that one's really tough. I can see. It's very, very cheap. So I guess there's a reason it's cheap. The margin is under a lot of pressure. There's not much growth, and then the earnings outlook isn't great either. So it's probably the worst performing bank at the moment within Australia.
Yeah.
So
Are you less keen on regional banks at the moment?
yeah, I'm less keen on regional banks, but Bendigo just reported a fantastic result, I must say. But I just think if you have to if you have to buy a bank, I'll buy Macquarie Bank.
Yeah.
And if you have to buy domestic bank, I'll probably sit in the CBA. If you have to buy regional, I'll probably sit in the Bendigo. So, that's the quality spectrum that you're going
Okay.
down to.
What about an unusual company for most people? Lifestyle Communities.
I like the company,
Yeah.
but it's I think
I
it's
like
had
the
a
way
lot
you
of
said
issues.
that.
I like the company. Yeah, I've been looking. Yeah, so it's got a bit of issue in the last 6 months. They had to raise equity. Look, the main problem is you can't actually find too many assets that give you exposure to residential market in Australia. The builder's been taken private, and then even the larger ones, you've got Stockland and Mirvac, they're not pure play residential. So both the engineer and lifestyle community are the sort of pure derivative of the residential, because we know the shortage of housing supply and everything.
Yeah.
It's meant to be great. Only problem is it's heavily exposed to Victoria. And that's been really, really tough, that market. So I think, it's
Yeah, because even at the moment we learnt today
really
that
tough.
both Brisbane and Canberra, their median house price is higher than Melbourne.
Exactly. Melbourne just being in such tough space, and that's why this company had a couple of downgrades. So I do think eventually things will get better. It's just that Melbourne market skews making it lagging the others. But I do like it. I think it has a really, really good asset backing.
Okay, just one last one. Weebit Nano. Have you ever looked at that company?
I think I tried to. I never really understood it.
Yeah, me too.
Yeah, and then it's a company that for a little while did quite well because it was included into certain index, and then sort of faltered away. I just don't know enough about this company, and I feel feels a little bit more speculative. I don't think it's profitable.
Yeah.
So I think it feels too speculative.
Well, now I might just do a related kind of company, Nanosonics. That's one you would have thought about.
Yeah, I do like Nanosonics.
Yeah.
Only challenge is that they got a new product that's just been delayed, and everyone's waiting for the new product to come through. And I think that's probably next financial year where they will roll out. Now, the question is, are you going to sell as many? And, there's just too much uncertainty with earnings. Probably more sort of neutral territory with Nanosonics. It's fallen a lot. I think there's value in this even without the new product. It's core business. There's value in it, but it's just because they're putting so much money into the launch of this new product, it's making losing a lot of money on that front. So we do need to see the new product come through to see what it looks like.
Jun Bei Liu, how long will you hold a company before you think, got it wrong, better sell?
I think every time when there's a news flow that come through, you got to assess it. And then if I feel I made a mistake, or whatever the catalyst I'm looking for.
You made a mistake.
Happens
Has
all the
that
time.
ever happened?
It happens all the time. So that's why we run portfolios. So we have got more right than wrong.
Yeah.
So it's almost you got to be very dispassionate when there's a new piece of information, and then reassess and ask that question. If the share price already fallen, just go, okay, would I buy more based on this new piece of information? If you say no, I wouldn't buy more, just sell it.
Yeah.
Because that's a way to assess whether you really think it's.
I remember going through the same process with Megaport. Bought early, did fantastically well. When all the tech stocks were smashed, it kept going lower and lower. The fund manager who put me into it wasn't answering my calls.
He's probably sold it.
It was actually a she. But no, I think she still supported it, but didn't want to go public on it. And it's come good because it's, in a sense, bad information, but it's started to be less bad information.
Absolutely.
It's started turning around.
Exactly. I totally agree. And I think Megaport is it's probably another derivative play of AI.
Yeah, exactly. There's one last question. I'm thinking what we might be surprised about over the next year is that lots of tech and even non-tech companies are going to explore the potential of AI, and there's going to be probably some surprising revelations for various companies, smaller companies that you wouldn't think of at the moment, would be great beneficiaries of AI, but they would be at this point in time exploring the potential.
Yeah, absolutely. I think this is absolutely true. And I tell you what, recently I went to a conference. So in the US, almost every corporate, not every, probably large corporate, most of the companies are talking about actual applications they can use of AI. So it's not just talking about potentially looking, explore. They are actually talking about actual applications. So, so to me, it's a matter of time before we see that across all our corporates.
And I feel that as though it will coincide with the time to cut interest rates. So many of these smaller growth or tech companies are going to get two tailwinds, namely lower interest rates, so less debt repayments, and secondly, the opportunities that come from AI, which must be a really good underpinning of the stock market, at least for a year.
Oh, look, I actually think the stock market is looking great. And I think these thematic will keep it going. And also on top of that, don't forget we've got all the M&A cycles. We got all of these are coming through as well, because stock market, to be quite frank, the last 12 months was way too cheap. People say it's overpriced, but it's not. So many very good value businesses are being bought out, and that will continue to support the share markets.
Great stuff. Great to see you. Thanks for joining us.
Thank you.
That's Jun Bei Liu of Tribeca Alpha Plus. And that was Jun Bei Liu of Tribeca Alpha Plus. Coming up next is Paul Rickard to look at income portfolios. If you're a subscriber to the Switzer Report, just hang in there. If not, you're going to have to be a subscriber to see the second half of the show. Thanks for joining us anyway.